Welcome to today's webinar, compiled and produced by the team at biznews.com. All of our webinars are interactive. We encourage you to pose questions to our guests. The more challenging, the better. And the earlier you get the questions in, the better the chance of having them answered. The recording of this webinar will be available later today on the biznews.com channel on YouTube. Lovely intro, isn't it? Okay, love that music. It means that you are with Biznews, the Biznews signature theme. And here's Kevin Shames with us today to go through one of the more interesting of the webinars that we've had in a little while. Kevin, I see you've got everything happening there. You've got we have tested the sound before. I can see your happy smiling face. Before we bring you in though, my colleague Stuart Lohman will tell us exactly how the tech works. Stu?
Excellent, thanks, Alec, and welcome, Kevin. Just quickly, for those on the webinar, there's a little high five button on the control panel on the right-hand side. If you can see Kevin and Alec presentation underneath them and hear my voice, can you give us a high five, please, just so we know everything's coming through loud and clear? There we go, Alec, we've got some of those high fives, which is always good, especially in the COVID world. We do like to keep it very conversational. There's little questions dropped on that same control panel. If you put the questions there, Alec can pick them up and pass them on to Kevin as he runs through the presentation. But Alec, all good from this side. Have fun.
Brilliant. And as Stu's just said, there's the little question mark. It's so simple. I'm sure most of you have been on webinars before, and well, on our GoToWebinar before. But if this is the first time, you just click on that question mark and fill in the question, so I can pick it up and pass it on to Kevin. Okay, Linda says I don't have audio. Linda, I hope the audio is coming through now, because it does appear as though everybody else. In fact, let's just double check on that one, Stu, if we can. Sure, you can see us, you can hear us. We've had the hands raised. Everybody else seems to be okay. Hopefully, Linda, it's going to be all right for you as well. Otherwise, it might be a setting on your own computer screen. Kevin Shames is a gent I've known for a long time. Mercury Alpha Capital. I see Mercury Consolidated Holdings. Nice picture of you, Kevin, when you came into the studio the other day. How's COVID going for you, your side?
Going well, Alec, as well as I guess we can be in a global pandemic situation. So obviously frustrating in that we are all locked in our homes, but from a business point of view, we are working 7 days a week at the moment. We are very busy, and obviously we got some catching up to do from the lockdown period last year, where we weren't able to do any deployment, but we are trying our best to catch up.
Indeed. This little screen, or rather the slide that's on screen at the moment, gives a little bit about your pedigree and your history, CFA and CA. So those are two pretty heavy qualifications. What took you into entrepreneurial work with this 12J company?
Well, I've been an asset manager for 30-something years. I started trading when I was at school, absolutely loved the financial markets, got involved early on in the futures market. Then I was at Investec, and kind of grew through my career, and have run hedge funds and long-only funds. And this really was incredibly attractive to me, this Section 12J business, for a number of reasons. First of all, we are an approved asset manager because we are managing other people's money, so we are highly regulated. But what I really enjoy about this form of asset management is it's not me making a judgment call on whether I think Anglos is cheap or expensive, or the Rand, or any kind of underlying asset. This is long-term contractual, predictable contractual flows. And that makes it very attractive in that our returns aren't subject to a movement in the exchange rate, a movement in equity markets, interest rates, because once the money is deployed in these long-term contracts, and these contracts can be for as long as 25 years, then it's really just about selling the electricity on a monthly basis, collecting that money and returning it back to investors in the form of dividends. So it makes the long-term predictability of what we're doing far greater. And I must admit, as I've kind of aged, I really enjoy the predictability, and I'm very happy that I'm not trying to pick stocks and assets like I used to.
Well, we've got a few slides to go through. I've pulled them out of your pack that you sent me. But first of all, just to show exactly what it is that you do, that looks pretty nifty. A car park with solar panels on top of it, something that you guys have done.
So we do this quite a lot. It's solar carports where there's limited roof space, or alternatively where the client specifically would like solar carports as part of that installation. This costs the body corporate or the client, whether it's a commercial, industrial, or residential client, costs them absolutely nothing. We pay the full capital cost of this installation, and those solar panels then generate energy, and we sell that electricity to them in this long-term contract, what's commonly referred to as a power purchase agreement. Our term for it is an ESSA, an electricity supply and services agreement, essentially the same thing, where we sell them the electricity generated from the solar in a contract for as long as 25 years.
How long does it take the company, Bright Light Solar, to actually get its money back from an installation like this?
So we don't look at it on a payback basis like kind of many homeowners would, for example, because we are deploying investment capital, and what we want to know is what the return is on that investment capital. And for this capital raise, that return is a 19% after-tax IRR. I'm sure we're going to get into that in a little bit more detail just now, but we really look at it on that basis. Is we have a long-term contract. How long is that contract? What are those contractual flows? And what are the returns that an investor will receive as a result of those contractual flows?
Here's another one, another body corporate. Where is this Comet Oaks?
This is in Bloemfontein.
Okay, and I presume that where all the solar panels are there is facing the sun, or the best part of the sunshine.
So those are north-facing roofs, exactly.
Mm-hmm. How does all of this work, Kevin? Does the electricity that's generated by those solar panels go into the homes that they're on whose roofs they're on top of, or is it for the whole complex?
No, so it's for the whole complex. Because this is a body corporate, the body corporate buys the electricity in bulk from the Bloemfontein municipality, called Centlec, and then sells it to each individual unit owner. So each unit has their own electricity meter, and the energy from these solar panels gets fed into a ring, an electricity network in the body corporate. So even though it might be above unit 2, that energy is then available to everybody in the body corporate. Now remember, these are daytime electricity generation, because obviously it's solar panels. We don't have batteries, for example, in this body corporate. So it is a case of use it or lose it. There is no storage, and therefore we've got to size it correctly. So we've got to make sure that any energy generated during the day is actually used. Now, one of the unique features with I referred to it earlier, ESSA, our Electricity Supply and Services Agreement, is that the only obligation on the customer is to use our energy first, and if they don't have enough demand to use all of the energy that they are supplied, that is our risk. It's not the body corporate's risk or the customer's risk, whichever kind of customer it might be. So that is commonly referred to in the industry as what's called a take or pay clause. We don't have take or pay clauses because that can become quite punitive and therefore difficult for the customer to work out what their total cost of energy is going to be. So in very simple terms, take an example like this, and I don't recall the exact terms of this, so I'm making up some numbers here, but let's say, for example, the tariff from Centlec was R1.65 a kilowatt hour. Our tariff would be, say, R1.25 a kilowatt hour, and whatever amount of energy is produced and consumed by the body corporate would then be sold to them at that contractual rate of R1.25 a kilowatt hour.
Now that's when you're competing with the government or with municipalities, the public sector, very easy. In this instance, though, Supergroup is a listed company on the JSE. That looks like quite an impressive installation. What would something like that cost, Kevin, to the capital cost of something like that to yourselves?
So this one has actually been extended now. When we did this one, it was 757 kilowatts. That's now just under a megawatt. That's 1,000 kilowatts. You can work roughly on between 9 and 10 Rand a watt. So a megawatt would be about 9 million Rand.
Okay, and clearly they're using this through the day as well, being solar panels.
Absolutely. So their energy demand actually is greater than the amount that we can supply, but we have made a very big difference to them because of the benefits of solar.
And here's another commercial installation. Where's this? Kemp Star Mall.
So this is in Kempton Park, and this was actually one of our early installations. It's gone particularly well. You can see it's pretty much all the available roof space has been used. And what was interesting in this one is that even during lockdown, because there are grocery supermarkets in this mall, they were still using every kilowatt of energy that we were able to produce. So malls like this, for example, weren't affected at all by lockdowns. In fact, the only installations in our portfolio that were negatively affected during lockdown from a generation point of view or from a consumption point of view, we have 3 student accommodation facilities. And obviously, as a result of the lockdown and no students being in those student accommodation, those housing projects, is the consumption there was significantly lower than expected. And while I'm talking about kind of lower than expected, maybe I should mention as well that, and it's pretty obvious when you think about it, but solar obviously is based on the amount of sunshine that you get. We've just been through an incredible period in the last 2 or 3 weeks, for example, in Gauteng, where we've had lots and lots of rainfall over the last 3 weeks. That obviously does affect our solar generation. So because it is abnormal, our model does model specifically for typically what we look at is around 300 days of sunshine a year in South Africa. But when you do have extensive periods of rainfall like this in a particular geographical area like we've just been through, that obviously will affect our ability to generate energy. So we will be slightly below our budgets in terms of generation for January and February. Over time, doesn't really make a difference, but it is kind of very relevant given what we've just been through. The other point I do wish to make is that solar is not a load shedding solution. So what happens in a load shedding situation is that the inverter, just a kind of a technical background, a solar panel generates energy in DC, in direct current. It is then fed into what is called an inverter. That inverter converts that DC into AC, that's alternating current. That is much safer to be able to distribute. And also that is what all of our appliances work off, is 220 volt alternating current. The inverter has a safety mechanism built into it that when there is no input reference from the grid, because this is what's called a grid tied solution, when the grid goes down, what the inverter does is the inverter shuts down the ability to utilize that energy from the solar PV, and therefore solar on its own is not a load shedding solution. The only way to utilize that energy from solar in the event of load shedding is to either have a generator or a battery, because what that battery then does is it provides an input reference voltage into the inverter, and the inverter then doesn't know that the grid has gone down. But in a mall, for example, such as Kempstar in front of us, they don't have a battery solution. In the event of long periods of load shedding, this energy is then just dissipated and we can't use it.
So surely the next upgrade would be to put a battery in there. I just think about at home, and you guys did the installation for me at my home, which I thought was reasonably priced. And I know you didn't give me any special rates. Everybody else pays about the same, but I'm very happy for having that, because whenever load shedding comes along, my battery will then just kick in and away we go. But you'd think of a mall like this, it would seem to be an obvious upgrade for them. Would that be part of your business strategy?
Absolutely. So we are busy this year. For the first time, we've now seen battery prices that in dollar prices have come down. Obviously, with the rand trading at the moment at around 1460 odd, it helps us in terms of procuring these batteries from offshore, and that then translates into a tariff that becomes a lot more reasonable, and it's already tariff related. So, for example, if you are on a tariff of, call it R1.50 a kilowatt hour, it's unlikely that batteries are going to be cost effective for you. And remember, there's a difference here. So really there's two objectives in using renewable energy besides the green nature. The one objective is to maximize your energy saving. In other words, the cost that you pay for electricity, you want that to be as low as possible. And therefore, in the case, for example, of Kempstar Mall, we're able to offer them very substantial savings as a result of an installation like this. The second one relates to energy security. And in the energy insecure world that we live in South Africa, with constant load shedding, that creates obviously this insecurity as to when am I going to be load shed? Is the local municipality going to stick to the schedule? And what is the effect, especially with many of us working from home in this current environment? Are you going to be down for 2 hours, 4 hours? Is your substation going to break as a result of the electricity being switched on and off? And batteries then provide that energy security, but energy security typically does come at a cost. So what that means is that you will be paying a premium for that security. And I guess like we pay a premium for security, private education, private healthcare, there is also then a premium that is payable in the event of a customer wanting energy security.
Well put, and I'm very happy to pay that premium. I think most South Africans, or certainly most members of the Biznews community who would like to have energy security, are happy to do that. But thanks for clarifying that. Kevin, we're going to go into the details now of the offer in a moment, but before we get there, there are quite a few questions already. Rob Foreman asks, do the solar panels get weather and hail damage?
They are protected by very strong glass covers. So if, for example, you have golf ball sized hailstones, these panels are tested for that kind of hailstone, and typically they don't get damaged by a golf ball sized hailstone. But in the event of an unusual situation where maybe you've got tennis ball sized hailstones, then they might be affected. Certainly, what we do is we are responsible for the insurance and the maintenance of our installations. So in the event of anything happening to the installation, whether it is, let's say, hail related, whether it is theft related, it is our responsibility to replace those panels. We also have great technology that is able to monitor our installation, and we are able to identify per 2 panels if any 2 panels have been damaged, and we do that all remotely through our telemetry, and we can identify. So at Kempstar Mall, it's a good one that it's on screen. We had a situation last year where 4 panels were stolen. our system identified that those 4 panels that should have been producing energy weren't producing the energy. We sent someone out to have a look at those particular panels, and they had been removed. And then what we did, the customer wasn't affected whatsoever. We then went and replaced those individual panels. So, and then in terms of maintenance, we have maintenance crews that we send out to wash the panels. Obviously, in the kind of rainfall scenario that we've got at the moment, much less washing of panels, but certainly in kind of June, July, August, in the middle of winter, when we don't have a lot of rainfall in Gauteng, then our crews are quite busy in terms of washing these panels.
Is it a big problem that people stealing your panels?
We've only ever had this one, particularly at Kempton Mall, and then we had a situation which we never really got to understand, where there was someone threw a rock, a big rock, on one of our panels, which then clearly shattered. And then we had one quite interesting situation, is that we installed the solar installation and the inverter on a Friday. It was due to be switched on the Monday. On that Saturday, it was hit by lightning and the inverter was destroyed by lightning. So it hadn't even gone live yet, and that inverter then had to be replaced. That's life. That's why we pay insurance. And that was then replaced, and that site went live 2 days later. So by the Wednesday, they were live.
So before we get on to how the financial side of it works, your namesake here, Kevin, says a good question was raised on your company competing with a municipality for electricity sales. Can you sell to the municipality units that are not being used? And does the municipality penalize the place where energy is being created?
So that is called a feed-in tariff, and we typically don't size any of our installations to provide feed-in to the municipality at all. So we do self-consumption only, and the reason for that is that it is uneconomical to pay for the cost of generating that electricity and then sell it to the municipality, because the tariff that the municipality pays, where they do accept feed-in, that tariff that they provide is just uneconomical. So it just doesn't make sense to oversize the installation and then sell it back to the municipality.
So they got to get with the program and just reduce those margins somehow, and all will be more efficient.
I think there are lots of programs they need to get with, Alec.
Okay. Peter says he missed the first few minutes, but it's worth repeating. He asked about overcast conditions, and do the PV panels still produce electricity? Do they produce anything? You mentioned the weather we had here in Johannesburg over the past few weeks. Does that take you completely offline, or do they at least produce something?
They still do produce something, but certainly much lower than we would expect or forecast. Peter, what I did mention is that our forecasts typically work on around 300 days of sunshine a year. So we are factoring in roughly 65 days a year where they are not producing. So that is within our forecast. But you do sometimes have periods like the last 2 weeks where you've had consistent overcast and rainy conditions, which then affects the amount that is generated in that period. The other point to bear in mind is that solar generation isn't equal over the year, because obviously the sun is much lower in the sky in winter, and therefore the angle of sunshine hitting the panels is much lower, and that then generates a much lower concentration of radiation onto the panels. So what we do find is that the winter months have a lower yield than the summer months, as you would expect, and therefore the dividends that we pay once we are fully deployed are not evenly distributed. So the dividend for the 6 months ended August typically would be fairly significantly lower than the dividend that we would pay for the 6 months ended February as a result.
Makes a lot of sense. Okay, let's get into, before we do that, Manfred has asked a question. He says, is the proposed pricing structure change suggested by Eskom, where they want to hike the fixed line charge component, going to affect you?
Manfred, we don't know the answer to that. Typically what does happen is that Eskom proposes to NERSA how they would like the tariff structure to change. That then goes through a series of public hearings, and then ultimately NERSA will make a determination on whether they believe that is a fair proposal and whether it should be implemented. At this stage, all that Eskom have said is that they are looking to change the tariff structure in two ways. First of all, they're looking to remove what's called the IBT, the incline block tariff that exists in many homes. If any of the people listening or watching look at their utility bills, you'll see in many cases you have step 1 through step 5. Where the more electricity you consume, the more expensive it gets. That's what's called an inclining block tariff. So they are looking to remove that and move more towards a time of use tariff. And then there's this proposal where they want to implement a higher fixed charge. We don't know any more details than that, except that they are proposing it. We don't know what's going to happen, if it will get through or not. And therefore, I'm not able to assess what the outcome is likely to be or the impact on our business and consumers that wish to either pay cash or have fully funded solar installations.
Okay, well, let's move on to in summary. There is a 50 million rand capital raise. We spoke last night. You said 30 million's already, sorry, was it 35 million
35.
that has already come? So
Yeah.
you got 15, sorry?
So we're just over 35 million as of this morning. So we've only got about 15 million that is left available. Just a quick explanation as to why we are capping this at 50 million. One of the conditions of Section 12J is that and there are lots of conditions. This is a compliance heavy structure, but one of those conditions is that we have to deploy 80% of all of the capital that we've raised by the 48th month of our operation. That 48th month is February 2022, and therefore by the end of February next year, we have to have deployed, actually spent 80% of all of the money that we've raised. So if we were, for example, to go and try and raise 100 million in this current capital raise, that would put us under what we believe is undue pressure to deploy. It is not something, for example, it is not an opportunity that we are even able to miss. It's kind of one of those conditions that are cast in stone, and absolutely we have to meet it. And therefore what we did is we said, let's raise 50 million. That allows existing investors and a relationship that's very important to us, this one with Biznews, to offer these investors to invest in this capital tranche, the 2021 capital raise, but we are capping it at 50 million. It is written into our prospectus that we are only allowed to raise 50 million rand, and therefore, as soon as we hit that 50 million rand, we are not allowed legally to accept any more money beyond that 50 million, and therefore we will be closed.
And in previous years, you were raising over 80 million, so it's not a question of people not supporting the project or the idea, but it is that you will be battling or struggling to implement, say, 80 million rand in the next 48 months. So I think that's pretty well understood. You need to just unpack a little, if you would, the 12J, because this is the reason why you can provide such incredible returns, 19%, as you can see there, after tax on money put in now by year 6, and that's 90% per annum. And I see you've got a figure there of 17.5% after tax over 25 years. Let's just go into that, Kevin, if you would, and I'll come back to the capital raise in a moment. There's the slide that while we're listening to you, we can have a look at it, how the tax works, or how the 12J incentive, which is coming to the end, but we'll talk about that in a moment, has been around since 2009, how it actually was structured to work.
So the returns come in 3 buckets to investors. The first one is the 12J bucket, which, as the slide shows, if you are an individual earning around just shy of 1.6 million rand a year at the moment, you will be in the 45% tax bracket. And we've just made the assumption that to calculate the returns would be for a marginal tax investor. So if you were to invest R1 million, as the slide shows, you would be saving 450,000 Rand in tax that otherwise you would have paid across to SARS. What SARS is saying is that you now have this opportunity of investing that R1 million, not paying the 450,000 Rand across to SARS, and utilizing that 450,000 Rand as part of your investment capital, in effect saving that 45,000 Rand. So you get a 45% return in year 0 before, basically by the end of February. If you are a provisional taxpayer, you just don't pay that money across. It's done automatically through e-filing. One of the questions on e-filing is, have you invested in a venture capital company? Section 12J VCC. VCC means venture capital company. They use interchangeably, and you then get that immediate deduction of the amount that you've invested against your taxable income, and that then reduces your tax payable in the 2021 tax year, the tax year that ends in just over 2 weeks' time. So that is part one, bucket one of your return. The second part of your return relates to dividends. Thank you. There you can see our dividend yield. It is an odd shape. I can get into that shape just now. But that is the projected dividend yield over the 25-year period. What you can see is that it increases very sharply from year 1 through to year 2. That's as we deploy the money, we draw down the cash that sits with our independent custodians. We don't have access to the cash. It is all held in the custody account through independent administrators. Once our investment committee approves a project, we then send that approval through to our custodians. They then release the money for us to invest in those projects. Those projects then sell the electricity, and that electricity revenue is returned to investors in the form of semi-annual dividends that we chatted about earlier. And as those contracts then have these inbuilt escalations, that dividend revenue grows over time. I'll come back to the shape of the curve as I mentioned, but the second part of your return relates to the semi-annual dividend. And then the third part is an elective one for the investor, and that's if the investor chooses to exit the investment at any time from the end of month 60 onwards. Why month 60? Because in terms of Section 12J, one of the requirements for the deduction that SARS have offered you to become permanent is that you have to hold the investment for a minimum of 5 years. So the first opportunity you have to exit without there being a recoupment of that upfront 12J allowance is month 61. And we have really produced this cash flow scenario for an investor that chooses to exit in month 61. I want to stress again, there is no obligation to exit, and we have shown that 25-year IRR. These are contractual cash flows that last between typically 15 and 25 years, and you're welcome to stay invested for a full 25 years. But if you were to exit in month 61, as this cash flow scenario shows, you would then receive a dividend in year 5 of in the region of about 110,000 Rand, and a capital, a sale of your shares of around 850,000 Rand, 85% of your contributed capital up front. So you put in $1 million up front, it shows there on the screen as that negative $1 million. That 450,000 is the positive cash flow benefit that you get by the Section 12J allowance benefits. You can see there how the dividend jumps from year 1 to year 2, because now we've deployed that money, and now it's, instead of earning interest at a low rate of interest, it's now earning this electricity revenue or renewable energy revenue. And then we're assuming that you sell at the beginning of year 6. That sale at the beginning of year 6 does attract capital gains tax, And very importantly, the base cost for that capital gains tax calculation is using a base cost of 0. So don't feel too aggrieved. It is SAR's way of saying, we gave you this upfront tax benefit 5 years ago. All we're now asking is that if you choose to sell your shares, we are going to tax you on a capital gains tax rate with a base cost of 0. So you are getting two benefits there. You're getting the timing benefit. You've had the benefit of that money from SARS for that 5 years. You're also getting a rate benefit because you are getting a deduction at 45% and you're only paying capital gains tax at 18%. So our cash flow here takes account of that payment of CGT at the beginning of year 6. When you then run all of these numbers, and you can see there's a bunch of disparate numbers, it's very difficult for a human mind to comprehend what these different numbers equate to, and we are kind of used to thinking about what is an effective annual return. So there is this principle in finance called an internal rate of return, and that's called an IRR, and that internal rate of return takes these different cash flows and spits out a number that is an annual equivalent. And that annual equivalent rate, that IRR, is a 19% after-tax return. I want to stress that doesn't mean that you get 19% every single year consistently. As you can see from this cash flow, it is disparate. It is a result of the cash flows out of the business, but that then gives you an annual equivalent cash flow as if you were getting 19% a year IRR. And that really are the three buckets relating to the returns for an investor.
Well, as we can see from this slide, the most important clearly is the 12J benefit. The fact that you can write off or you can not pay over tax that you would have had to pay otherwise to SARS in year 1, that 450,000 that you've got here. Kevin, that 12J has been around since 2009. The industry only seems to have come alive in the last few years. Why do you think that was?
When the initial Section 12J was promulgated, it was largely unusable. There were conditions in there that made it very difficult to traverse. It really wasn't worth anyone's while. There were a number of appeals that were made to National Treasury to make it more usable. They then did that in around 2014, 2015, and thereafter 12J, largely in its current form, became far more usable, far more user-friendly. And that is what attracted people such as ourselves to this industry, to use this as an opportunity. Now, what was Section 12J intended for? This was not intended to provide high net worth investors an opportunity not to pay tax, obviously. Really, the ultimate objective behind Section 12J was a recognition that jobs are created primarily in small and medium enterprise. And the best way of creating those jobs was to incentivize high net worth individuals to be able to invest into those SMMEs. And the best way to do that is to say, if you invest in this company, which is called a Section 12J company, and that Section 12J company has one objective only, it is to invest in underlying SMMEs, and there is a specific term that is given to those SMMEs in terms of Section 12J. They are called qualifying companies. And so there's one job of a Section 12J company. It's to invest in these qualifying companies. And that is what Section 12J companies do. They invest and they ultimately create jobs. And it is that job creation that is the ultimate objective of Section 12J.
So the qualifying companies is what's all important here. However, and this goes to Guy Harris from Cape Town, his question, he says, will 12J be extended or even enhanced? And he's with impact investing. So clearly he's got some vested interest in all of this.
So Guy, that obviously is the $1,000,000 question that we are all holding our breath for. I was listening to the Sona last night to see whether whether our our state president was going to mention anything around Section 12J. Obviously, he didn't. I think he's leaving it for the finance minister in 2 weeks' time. And we are likely to get an indication from the finance minister as to whether Section 12J will be extended or not. So let's just unpack that for a minute. The current version of Section 12J expires on the 30th of June 2021. That's in, 4 months' time. Anyone that invests in any Section 12J in February 2021, that sunset clause has no impact on you whatsoever. And the amount that you invest now, you will be able to claim that Section 12J deduction without any problem. That sunset clause relates to people that invest in a Bright Light or another VCC after June 2021. And we are part of a Section 12J association. We've made submissions through to National Treasury on why this is a great reason that National Treasury should be looking to extend it. When you look at all of the taxes that are paid, it actually works out to a very low cost to National Treasury to be able to provide this incentive. So you get the 45% upfront tax benefit, but then there are a number of taxes that are collected as a result of this. So the qualifying company, for example, will procure goods and services. Those attract VAT. They'll employ people. There's a payment of PAYE. The qualifying company will hopefully make profits, and there's a payment of income tax. And ultimately, investors will sell their shares in the 12J companies. And as I've explained, there is a CGT payable with a base cost of 0. And when you take those tax receipts into account and offset it against the tax benefit, there is almost no tax cost to the country. And therefore, this really is a brilliant tax incentive to try and keep high net worth capital in South Africa invested in SMMEs. The problem is that it is a political hot potato because it is seen as a tax incentive that is favoring the rich over the poor, and therefore it might be politically expedient for National Treasury to not extend. Our expectation is that we are not expecting National Treasury to extend the Section 12J. That is kind of what we've built our business on, is that it will expire in 4 months' time. And if that is the situation, this then will be our last capital raise within the Section 12J environment. We'll certainly be listening very keenly to the Minister of Finance when he does speak in 2 weeks' time, but we are not expecting the Section 12J section to be extended.
It would be such a pity because, as you explained earlier, they started with something in 2009. It's been adjusted over the, no one was using it. It was then adjusted. People now are using it. High net worth individuals are putting money into this tax neutral investment. The employment is being created. People are getting jobs, which is the most pressing issue in South Africa with a high unemployment rate. So it really looks like this is something that actually works rather than grand schemes and plans that are thought up in smoky rooms and socialist propaganda purveyors. But whatever, the reality of this is that, as you say, it might not be politically palatable and it may well not be extended. And if that's the case, this is the last opportunity. We've got a opportunity for quite a few more questions though, Kevin. In terms of the agreement, says Colin, is it reflected as a contingent liability on the body corporate's balance sheet?
So on a body corporate's balance sheet, I'm not sure what the IFRS requirements are. I don't think, yes, I think it would be, they would still, if they are IFRS accounting, they would still have to raise both the asset and liability on their balance sheet in terms of the IFRS statement on leases, because it is a lease. It does get a little bit more complicated for companies where they then have to disclose that. But I am a CA, but I must admit I haven't been able to keep up with all the IFRS accounting, and therefore Just like I'm not a tax advisor and I don't give tax advice, I very much don't give accounting advice either.
Your namesake Kevin is back again. He wants to know, I love this question, can these panels generate enough electricity to make a train move?
I don't know that answer. I mean, I guess the train would have to be in sunlight. Certainly, if there was a way of molding the panels to the roof of a train, ultimately they'd be able to generate energy. And certainly, those are the kinds of opportunities that we'll see going forward, where we have flexible panels in the years ahead. Right now, they are non-flexible panels. They're quite stiff. They're also quite fragile. You don't really, for example, want to be standing on them because they crack. So right now, no, I can't see them being used on the roof of trains.
It's a very good question, though, given that we need to get our trains moving again, and it looks like the normal electricity lines are no longer functional. Diesel's very expensive. It's an opportunity, and hopefully somebody is thinking about doing just that. Fikri asks, what would be the investor return excluding the tax benefit?
So before I answer Vikri's question, I just want to mention, you talk about great technology breakthroughs. China built a highway using solar panels embedded in the tarmac, and there was a 4-kilometer stretch of highway. And if you have an electric car and you drive over that 4-kilometer stretch, it would recharge your battery. I don't think it went particularly well, but those are the kinds of opportunities that you could be looking at going forward. Vikri, to answer your question, the answer without the 12J benefit is you're looking at between 12.5% and 14% roughly as a return. If you look, for example, at the return that a minority investor gets in our qualifying companies, it's between 12.5% and 14%.
Wow, that's still pretty good, Kevin. Is that after or pre-tax?
That's after tax. That's dividends.
Oh, that's a good number. So even with 12J disappearing, you may well be looking for money next year.
Alec, yeah, let's talk about that next year.
Okay. Well, 12.5% is pretty good in this day and age, and particularly if you can have it over the long term. Manu asks, is there any floor or minimum to investing in your fund this time around?
Yes, there is, Manu. The minimum is 100,000. The maximum is 2.5 million for an individual or a trust, and 5 million for a company.
There it is on screen. Sorry, Manu, I should have seen that myself. Greg asks, have you started installing batteries with your PV systems yet?
So batteries really are only becoming cost effective now, in probably this year, I would say, in terms of cost effectiveness. So generally, we haven't installed batteries anywhere. Clearly, one of the opportunities that we have is we've got about 100 sites where we have installed solar PV. And then one of our opportunities in the year ahead is to go back to those sites and then offer them battery storage. Obviously the easiest cost of customer acquisition is to go back to your existing customers. So yes, that is something that we are definitely considering as soon as we are happy that batteries are sufficiently cost effective.
Peter's back with another question. He says, within the 25-year projection, I imagine you've built in the replacement cost of batteries and panels when they reach end of life.
So Peter, the warranted life of the panels is 25 or 30 years, depending on where you get the panels from. Just a quick aside, we only use what are called tier 1 panels. Tier 1 is a categorization that Bloomberg have created, where they look at the ability of those panels to generate the required amount of energy, as well as the balance sheet of the company that is selling you the panels. So I'll take an example, Canadian Solar or Trina or JA. These are the names that are tier 1 panels, and Bloomberg have then looked at the quality of the panels and the quality of the balance sheet, and our mandate only allows us to use tier 1 equipment, and they are then warranted for at least 25 years. And then what we've done is we've even taken reinsurance on the companies that provide us with a warranty, with companies like Aon and AIG, that in the event of those, let's say, Canadian Solar not being around in, say, 15 years' time, when we want to make a warranty claim, we can then claim back from that reinsurer in the event of not being able to claim back from the manufacturer.
Kevin, I wanted to ask you a little about this on fees, given that it's something that we here at Biznews bang the drum on often. Warren Buffett says that you should be paying a lot more attention to the fees before making an investment. Can you unpack this for us, please?
So fees are probably the real hot potato in the 12J industry. And many of the 12J companies charge you very high fees. And the kinds of fees that you can see is, you can see capital raising fees. We've seen capital raising fees of 3%. That means that if you invest 100 Rand, 3% is paid away and only 97 Rand goes to work. Many of the Section 12J companies charge you a performance fee on your tax saving, so that 45% tax saving, you invest R1 million, you're saving 450,000 Rand in tax. Many 12J companies will charge you a performance fee on your tax saving, 20%. So you are, of that 450,000 Rand saving, you're going to pay 90,000 Rand away to many of these managers. What have they done? All they've really done is use the provision that SARS have made available in the Tax Act, and they're charging a performance fee on that. We find that totally unacceptable. And then the other factor as well is that there are very high management fees and performance fees. So what you'll typically find in the 12J space is that there'll be fees, for example, of 2% ongoing fee and a 20% performance fee. That means that you're paying away a ton of money in fees. Now, when you look at our returns at 19% and you look at other 12Js that maybe are offering you, call it 13, 14%, and I'm not picking out any individual one, I'm just saying generically, the difference between those returns is not that we have a much higher yielding asset. The difference between those returns is very simply 4 letters: fees. So really an investor needs to put a lot of emphasis in understanding what fees are being charged to you as an investor. They are also quite opaquely disclosed. They're disclosed in a way that says, we are charging you 2 and 20 above risk capital. Have they disclosed what those fees are? Yes, they have, 2 and 20 above risk capital. Does any investor understand what 2 and 20 above risk capital means? No. What does 2 and 20 above risk capital mean? Well, your investor capital is R1 million. Because you're getting 450,000 Rand back, the capital at risk is deemed to be 550,000 Rand. So that's the 20% that they're charging you on your tax saving. The 2 and 20 relates to the 2% fixed management fee and the 20% performance fee. You can see why it is opaque. As I say, they are disclosing it, but no one typically understands what that means. So what do? We charge you not 1 single cent of fee in the VCC. Why do we not charge fees in the VCC? Because I mentioned earlier that the VCC is simply an investment company. It receives capital from investors and it takes that capital and invests in underlying qualifying companies. Alec, you've got a slide there of the structure, the organogram, effectively, of Bright Light. And what we then do is we are investing in these underlying qualifying companies. What is the return that the venture capital company is getting? It's receiving dividends from these underlying companies. And if you remember that dividends received by a company are exempt from tax. So if you are charging fees in the VCC itself, those fees have no tax deductibility, and therefore not only are they expensive, but you're not even getting a tax benefit because your income is tax exempt. It's in the form of dividends. So what we've done is we've said, and I guess we're quite fortunate in that we manage the entire ecosystem within Brightlight. We aren't going and looking for other renewable energy companies to invest in. We invest in a company called, let's say, Brightlight Solar Bloemfontein, and that is a qualifying company that houses all of our projects in Bloemfontein. We manage that underlying qualifying company, and we only take our fees at that qualifying company level, and that is 17.5% of the net income before tax and depreciation and management fees in that qualifying company. What that means is that an investor's money that hasn't yet been deployed, it's sitting in the venture capital company in our administrator's account earning interest. We don't get to charge any fees on that whatsoever. So our interests are totally aligned with an investor's interest, and we only get paid once that capital has been deployed and is now generating income in the qualifying company. And I am proud to say that Brightlight is, as far as I know, by far the lowest cost VCC from a fee point of view in the VCC industry. And as a result, when you look at the returns, I had a long chat to an investor this morning, and he said, Kevin, 19% seems too good to be true. Well, when you unpack it and you understand that we are selling energy from renewable energy assets, they are generating these contractual cash flows, and we are minimizing the amount of fees that we are deducting, and you then couple that with a 12-day benefit, that is how we are able to get to these 19% after-tax returns.
Well, we're coming to the end of today's session, so I have a few questions, Kevin, that we'd like to cover before we go. Fikri's back again. Says, how much would you be paid for your share if you sold it later, for example, in year 10, 15, 20, or 25?
Oh, can you hear me?
I've got you back now. Yes, Kevin.
Hello?
Yeah, I've got you. Yes, I can hear you now.
Okay. Sorry, I lost you. How much? Won't you repeat the question, please? I lost you.
The question was, what would you be paid for your share if you didn't sell in year 6, but rather sold in year 10 or 15, 20, or even 25?
So I have actually calculated that for an investor yesterday. I've calculated it every year. I'm able to share that with anyone that would want. So if I just quickly open that, if you sell, so pick a year, Alec. Which year do you want?
Say year 15.
So year 15, you would sell your shares for around 74% of the value. So if you bought R1 million, you would sell them for around 740,000 rand.
Excellent. Peter says he promises this is his last question. Well, it has to be because we're about to end. He says, how do you sign up?
So go to www.brightlightvcc.co.za. So it's BRIGHTLIGHT VCC.co.za. Click on the investor tab. You'll see all the documentation that you require there. Or alternatively, Alec, you can guide them through the Biznews website.
Yeah, very easy. You go into Biznews and there's links through to Brightlight as well. And Greg, finally, the final question here is from Greg. He says, how will the general shift to work from home affect your potential market?
Greg, we are anticipating that's quite a significant shift. We are in the process of launching our residential offering, which will go live in the next month or so. And there we will be providing fully funded solar and battery and hot water solutions into the freehold market. And we are anticipating quite a robust take-up of that offer because bundled in there is a battery, which would then provide you with a load shedding solution. How big is that demand going to be? I have no idea.
Kevin, I think that it's bigger than you could ever imagine, because if you're going to make installations for work from home people at no capital cost, and just a contract to continue paying into the future. It sounds like, it almost sounds like that 19% per annum, too good to be true. How are you going to convince people that there isn't a con in all this?
Well, they're buying electricity and they're buying energy security. So there's certainly no con. It's all done through a prepaid meter, so we don't have counterparty risk. And I think that's very important because we are very aware of counterparty risk, especially in these troubled economic times that we have. And what we do want to make sure is that we prioritize and continue to prioritize the cash flow back to our shareholders. And that means we have to be able to collect that electricity revenue. But look, the cost will be greater, as I mentioned earlier, than just your cost if you're buying it from your local electricity supplier. But that is a premium that you're paying for the energy security as a result of what a battery offers you.
How much greater?
It really depends. It's kind of like how long is a piece of string? I can't answer that because I don't know what the tariff would be in each person's residential area. So that tariff could be if you, for example, living near Eskom, that's a very low tariff, wouldn't make sense. Whereas if you're living in Ekurhuleni, it's a very high tariff. So it really depends on your area. Our tariff is not dependent on your tariff. Our tariff is purely based on the cost of installing and being able to generate the return for our investors.
Can you take people off the grid? Let's just say there's someone is getting Eskom power, but they're out in a rural area. I'm just thinking of my farming days.
So we can. We, for example, as a company, in terms of our SRI initiative, are in the process of providing an off-the-grid solution to an orphaned rhino sanctuary, a really, really special investment that we as a group are making, where we are providing them a battery that's housed in a 40-foot container, a large solar installation, and as a group, the Bright Light Solar Group and Sectional Title Solutions, our sister company, are providing this for free to, it's called Care for Wild. If any of you want to go and look, it's an amazing rhino sanctuary. So yes, the answer is we can take you off the grid, but an off the grid solution is very expensive. It's certainly, you need backup power, as the last 2 weeks have proven. When there isn't enough sunlight to charge your batteries, you then need a generator. It's not something we propose to customers. Rather stick with a grid-tied solution, but try and minimize the amount that you're drawing from your local energy utility where possible.
Kevin, thanks very much. I know you have been inundated and it's right in the middle of the capital raise, but Biznews community members who attended today and those who've expressed interest will be highly appreciative. I think we filled pretty much all of the questions that we could have. The details all there. There's pretty easy now to understand whether this works for you or doesn't work for you. If you are a taxpayer in South Africa, it's hard to see how it won't work for you. But we look forward to hearing when everything's being closed out. As you say, 35 million already allocated, 15 million left. So I guess it's not going to be too long. Certainly it doesn't look like it's going to continue until the 23rd, which is officially when you're going to be closing. So I think what you said earlier, once that 15 million has come in, then you close. You can't, you're not going to allot over allocations or when you have an oversubscription.
No. So what we'll do is, as soon as we hit that 50 million, assuming we do hit that 50 million, as soon as we then hit it, is that any subsequent application, we will immediately advise that investor that we are now fully subscribed.
Kevin James is the Chief Executive of Bright Light Solar. I'm Alec Hogg. It's been our pleasure to bring you this webinar with our business partner, and hopefully you feel a whole lot better informed about this. Until the next time, cheerio. Thank you for joining us for this webinar, which is compiled and produced by the team at biznews.com. A recording of this webinar will be available later today on the biznews.com channel on YouTube. From our team, until the next time,
Cheerio.